Great to have you with us. Well, one of the big stories of the week was the decision by the Bank of Canada yesterday to cut interest rates for the second consecutive meeting. And while obviously central banks have been worried about the inflation story for a long period of time, increasingly it seems like our Bank of Canada is growing concerned about the health of the Canadian consumer. Higher interest rates have obviously played a large role in that. And certainly there's starting to be a change in the narrative from the Bank of Canada around some of the risks for parts of the Canadian economy. We've talked a lot about issues such as mortgages having to be renewed at much higher rates in this country, and that being one of the key differentiators with the American market. Well, our next guest has been talking about that issue for some time now and joins us with some perspective on what more the Bank of Canada might be thinking about as we roll through the rest of 2024. Royce Mendes is Managing Director and Head of Macro Strategy at Desjardins. Royce, it's great to see you. First of all, I'm going to imagine you were not surprised to see the Bank of Canada cut interest rates yesterday.
Not surprised at all to see the Bank of Canada cutting interest rates. We were pretty confident that that's what they needed to do based on the data, but we were pleasantly surprised about how dovish the central bank sounded about what's to come. They seem a whole lot more balanced than they were at as recently as their June announcement day. They're not talking about rate cuts being gradual anymore. They're not talking about these four key criteria that they need to see to have more rate cuts come. It seems like they are expecting that unless something changes, there's more rate cuts coming. So we're forecasting another 2 rate cuts for the remainder of this year. We'll get down to a 4% policy rate by the end of 2024, and then a series of rate cuts in 2025, getting down to 2.5%. That has been a long-held forecast of ours. When we first issued this over a year ago, it was labeled as very dovish, but now it's basically consensus. If you look at how far the market has moved, how far economists have moved in terms of pricing in additional rate cuts, you can see how much ground it has been covered in narrowing that gap. Our forecast was always predicated on that mortgage renewal story and the simulations we did, and it continues to guide our thinking about what's to come in the future.
Yeah, just the math that over the next few years, a large swath of Canadians who haven't felt the sticker shock so far will feel it if rates stay at current levels.
Absolutely. If you look at our simulations, you can see that if we don't get enough rate cuts, you could see some variable rate payments jumping as much as 60 or 70%. I mean, even if we get the rate cuts we're expecting, people with variable rate mortgages that were taken out in 2020 or 2021 will still see pretty large payment shocks. It's just that they'll be more manageable. So we're not saying the economy is going to face no headwinds, even if we get the rate cuts we expect. What we are saying is if the Bank of Canada continues this consistent cutting cycle, we hope that the economy will be able to avoid a recession.
Being able to pay your mortgage is feels like a point of pride, quite frankly, for Canadians. Yeah. Like, I think one of the things when other countries are looking at what's happening here in Canada and predicting doom, maybe they know a little bit less about how our housing market operates. Yeah. And yet, there is this big question about how people are going to pay their bills if they don't have a job. And the unemployment rate has been rising. It's well above 6% at this point. But I think what's also worth pointing out at a time when we've had record population growth in this country, not just that the pace of jobs didn't keep pace with the number of new Canadians that we're seeing, but people who have come to this country, call it over the last 5 years, there is a very high unemployment rate amongst new Canadians. And that has to be concerning to everybody who's part of the story of growth for Canada, and certainly something that factors into where the economy could go if rates stay at elevated levels.
It's very difficult if you don't have a job to find a job. So we're talking about new Canadians, but it's also students graduating from high school, college, university, finding it very difficult to get a job. What we're not seeing, though, on the plus side, is people with a job losing their jobs. business. So what's happening right now is the unemployment rate is rising. It's mostly because of newcomers and students not being able to find work. That is largely not a group of people that tends to have mortgages and large mortgages. The people who have the jobs right now are the ones that tend to have the really big mortgages. So it is good news that those people are keeping their jobs. It's good news that they are likely still able to pay their mortgages even if there is a payment shock. What will start to worry me is if we start to see outright job losses. It's not something we've seen in large numbers. It's really just a story of newcomers and students not finding work and adding to the unemployment rate that way.
But for them, they're certainly more cautious with their spending, and anybody who is paying a higher mortgage is being more cautious with their spending. We've seen that reflected in things like retail sales, et cetera. So you are anticipating more rate cuts. That's been pretty common as a theme I've heard from a lot of economists over the last 24 hours. I will come back to the story of the United States. I mean, even this morning, we got some fresh economic numbers that showed arguably some resilience. Recently, some former Fed officials were saying it's time to cut rates in the United States. But throughout all of this, there's been a lot of question around how far the Bank of Canada would want to go, how far it would want to diverge from the United States. Does that open a Pandora's box, with the Canadian dollar weakening and then us importing inflation? So I guess when you think about the flexibility Canada has to go on a different monetary policy path than the United States, where do you land right now?
I think there's a fair bit of flexibility still there. So if you look at the Canadian dollar selling off over the last 24, 48 hours, it's been led by a risk-off sentiment broadly in markets and lower oil prices. Yes, the Bank of Canada sounded dovish and interest rate differentials did widen a little bit with the U.S., but I wouldn't say that was the primary driver. I would say those other two factors were more important. The interest rate differential component, yes, it can drive Canadian dollar weakness, but the other factors tend to be much larger drivers. So I'm talking about risk sentiment, I'm talking about energy prices, and I'm talking about broad U.S. dollar moves. So I'm not too worried about the Bank of Canada potentially needing to diverge from the Fed, even if they cut interest rates in September and the Fed maybe puts it off another couple of months. But my assumption is at this point is that the U.S. Federal Reserve does start cutting interest rates in September. So the interest rate divergence story won't be around for much longer. I think the Fed, as you said, Bill Dudley, former New York Fed president, former chief economist at Goldman Sachs, talking about the need to cut rates maybe at the end of this month. I think today's GDP data and the inflation data that comes out with that GDP data suggests there doesn't need to be a rush, but September still seems like very much a base case for a rate cut in the U.S. from the Fed.